So first, I'd like to welcome everyone to the SHAC faculty series. And today's topic is valuation. How does the market value real estate in a stressed environment? And we're fortunate to have not only an expert and professional in the industry, but also a very good friend and former colleague, Lev Yagodayev, who is going to be co-presenting with me today on the topic of valuation in a stressed environment. So today, we're going to start off with some brief introductions. We're going to talk about the definition of values, because it's not always market value. Valuation in a normal environment, valuation in today's stressed environment, a little bit about financial reporting valuation and the concept of impairment. And then we're going to talk about a few other capital markets requirements that are looking at valuation and understand how those are affected in the stress environment. And then we're going to end with questions and answers. So at this point, I'd like to turn it over to Lev Yagodayev, who's an MAI and principal of Level Valuations, to start off his component of the presentation. Thanks, Lev.
Hello, everybody. Tino, can you give me ability to do a screen share?
Yes.
Okay, just want to say hi to everybody. Hope you're doing well and staying healthy. While I am trying to do screen share, just want to remind everybody that we will do question and answers at the end. So please use the chat feature, put questions there. We will monitor them, and at the end we'll answer them. And if there's certain questions that you want to just address to me or to Tino, just designate that in the chat, and we could do that.
So Lev, you would think after so many months of staring at the screen and using Zoom that I would have the ability to give you that.
If you just end screen, exit screen sharing, then I'll give it today.
Okay.
Perfect. Okay. All right, everybody. Tino, you see the slides? I can't tell.
I see the slides, but I also see the next slide.
Okay, maybe I shared the wrong screen. No, okay. Tina, maybe you want to do it. Let me stop then. I thought.
Sure.
Yeah, apologize, guys. Give us a few minutes to deal with technological.
Here we go.
Okay, so slide number 3, please. Perfect. Okay, so what you see in front of you is a chart which shows commercial real estate property values that are tracked by Moody's Real Capital Analytics since 2007. So 2007 was the last recession that we went through, and so this is why I'm starting from 2007. As you can see, property values have been increasing up to the point of the pandemic. So this is the latest data as of March 2020. You could see that property values fell. They reached a peak in mid-2007, then they fell about 30%, started to recover in 2010, and then by the time March 20th hit, we were 35% above the 2007 peak in terms of commercial real estate property values, or more than double from the bottom reached in 2010. Tino, next slide, please. So the question everybody's asking now is, okay, where do we go from here? Do property values continue to rise? Do we sort of level off, or do we go down? So this is the question on everybody's mind. I will tell you right now that nobody knows. I was actually listening to a presentation a couple of days ago where the panelists were joking around that the way this was brokers, the way they determine values is they put a couple of ranges on a whiteboard, then they put a blindfold on, throw the dart, and then whatever the dart lands, that's as good of a guess as anybody has in today's environment. So just joking aside, you know, the goal of today's presentation is not to decide, okay, which direction the values are going, but more for me to share tools that one can use to estimate value. And just, you know, by way of background, I started my career 20 years ago. So this is sort of the third economic downturn that I will be living through. But, you know, the first one in 2001, I was in college. So that one sort of blew past me. I didn't really learn too much. Didn't really realize that it was even happening. But the 2007 recession, I was already active, already had a good understanding of economy, how things work. I was at Deloitte at the time and working with some of the biggest names in the business as to, okay, where are values? How do we price things in a new environment? And so I'll share some of the tools and techniques that I've learned back then and used ever since, and that obviously will be very applicable today. Tino, next slide, please. But, you know, before we talk about, you know, market value or value in general, I just want to just highlight that there are different types of values out there. The most common definition or type of value that people are familiar with is market value. And the reason for that is because, you know, most appraisals that get done are for lending purposes, and lenders, because of regulations, require market value as the definition. However, there's others, as you could see. You have fair value definition that's used in financial reporting. This is for financial statements that accountants use, and then you have ad valorem that's used in tax reporting. But there's many others. So just, I want to go through the definition of market value, not just so that you guys memorize the definition, but more of, I just want to highlight some of the challenges appraisers whose job it is to come up with value for real estate will face in applying this definition. So if you read just a couple of key terms, so market value is the most probable price. So if you think about this term probable price, it suggests that you have an asset that's on the market, you have many people bidding on it, and the most probable price suggests some sort of a statistical average or some sort of a mean where most people bid to a price. So if you think about environments today, there's probably there's probably fewer players today bidding on assets than there were before pandemic happened. I'm not saying that liquidity isn't available, but you can imagine fewer players bidding on assets. Then you have, just if you read in the middle, it's assuming that the price is not affected by undue stimulus. So this term undue stimulus suggests that, okay, you know, buyer wants to buy and seller wants to sell. However, I'm thinking that going forward, the only seller, none of the sellers will want to sell. They will sell their asset because they have to sell. So this term undue stimulus, if you're an appraiser trying to apply this definition of market value, this is going to be one of your challenges. Specified date is an important component of any market value or any definition of value. So value is only valid as of a date that you're you're working with. As you can see, if you follow the news, things are changing new information comes in all the time. There's a vaccine, there's not a vaccine, there's a drug, there's not a drug. So you can see that things will be changing day by day and they'll be moving very quickly. And also, if you think about just going back to, let's say, doing an evaluation of an asset in January or December, before this whole thing started, completely different process or mindset than if we are trying to do something today. So, next slide, please.
And Lev, one thing I might add to that comment about, the timing, one of the things that's also interesting about the timing that things kind of accelerated with COVID is the shutdowns and the stay-at-home orders really started to come into play in mid-March. And for institutional owners that analyze their portfolios on a quarterly basis, like NACREIF, which is pension fund and institutional money, insurance company investments, state pension funds, other public pension funds, the timing was such that the beginning of March, you had tenants that were paying rent and debt service that was being paid by borrowers. By the time you got to the end of March, which is that effective date of appraisal that Lev mentioned, the perception of the market is very different. So at that point, at the end of the quarter, how much of the uncertainty do you take into account in trying to come up with an opinion of market value as of the end of March 31st, when it's really there's a significant amount of uncertainty, and you don't want to create too much volatility in value measurements by hitting property values very hard because of draconian assumptions, or not considering the fact that we have this uncertain period of time. So the timing, to Lev's point about the valuation date, was also kind of interesting in terms of when it hit.
Yeah, so I'll give an example about that being too close to the data value later on. I'll give an example that we dealt with pretty recently. So just to continue with the definition, another important component of definition assumes that you have an asset that is being put on the market. So just to back up a little bit, market value, any type of value is an exit concept. So you assume that a transaction happens. So anytime you value an asset, you assume a hypothetical transaction. When you assume that, you envision a scenario where an asset is put on the market, and there's enough time, enough exposure time for the market to sit, for people to find out that, okay, it's being offered for sale. There's enough time for them to visit it, analyze the leases, look at the financials, go through a typical due diligence process, and then submit a bid. Again, I envision a scenario where any deals that will be happening going forward are going to be done quickly because of some sort of a distress or stress in the market. So this is another challenge that we will be going through from an exposure time standpoint. And the last thing I highlight is traditional financing. So market value assumes that traditional financing is available. You can imagine for certain property types such as hotel and retail, it'd be very difficult today to obtain traditional financing, because I could see many lenders being cautious or unwilling to provide financing. So that's another aspect that another challenge that people will face in applying some of these definitions. And again, just something for everybody to think about. Tino, next slide, please. So let's spend a few minutes talking about how do you do valuation in a normal environment. So since I do this, day in and day out, let me walk you through a typical assignment. Client calls, says, go ahead and give me an appraisal on an asset. So, I get in a car, I visit the property, I look at as many spaces as I can. Sorry, that was a message machine. So I get in the car, I walk the property, walk the neighborhood, inspect the comparable properties to the extent that I can. come back to the office, analyze the leases at the property, look at the historical financials, estimate what I think is going to be cash flows or rents coming in, expenses coming out, and come up with my net operating income. So in most cases, most assignments, I don't have to come up with a net operating income for more than a year ahead. Once I come up with my net operating income, I extract what the typical capitalization rates are in the market where I'm working. So divide the NOI by the cap rate, and I have my value for the asset. Then I look at the transactions, make sure that my price per foot, price per unit, those metrics line up, and I'm done. Obviously, I'm simplifying the process a little bit, but in a normal environment, this is what an appraisal process will be. Okay, Gino, next slide, please. Now let's think about the current environment. So the current environment, you have tenants, and this is across property types for the most part, they are not making rent payments, right? Many tenants, when we come out of this, hopefully sometime soon, are gonna go out of business. So I might have a building with no tenants. Not only that, I today don't know when if I come back to a building with no tenants, when will I be able to get a new tenant to come in? Obviously a lot of my competitors are dealing with similar circumstances. They also are losing tenants in the tenant benefit. So the direct cap method, which I described before, is ineffective. You cannot apply it because you don't know what your stabilized and net operating will be. There are limited or no transactions. So looking at metrics such as price per square foot or price per unit is also not very relevant, because those are based on sort of normal economic conditions and under scenarios where you are collecting, your property generates cash flows. Okay, so what can I do, right? This is the main question. So let's the techniques that I need to use is the discounted cash flow method. And the discounted cash flow method looks at the future 3, 5, 10 years from now. And in that scenario, you try to predict what will happen in the future, what a recovery will look like, how it will, will it be a U-shape, V-shape, however you think is reasonable. So this is the tool, this is the technique that we will be using as valuation professionals to come up with values going forward. And obviously, the way you build your discounted cash flow is going to be based on property type and the market that you're in. But let's sort of brainstorm through how to do it. Now, the big question is, well, if you build a discounted cash flow, there's a lot of inputs, and it becomes very subjective. So how do we decide what those inputs are? And I listed here three approaches, 3 techniques that we can use and that I've used, and let me walk you through those. So the first one I've learned during the 2007 downturn when I was at Deloitte, and I've learned it by reading a paper that was published by Peter Korpax, where he talked about the refried, what he termed as a refried sales analysis. And in this article, he talked about when you are in a period where you have a completely different economic situation, completely different capital market conditions, completely different leasing conditions, what you can do is you can look at transactions, sales that took place before this economic dislocation took place, contact the buyer or the seller from that transaction, and ask them what inputs they would change in their analysis, or what assumptions they would change if they were to do a deal today. So let me give you an example. I worked on a deal that recently closed. It was a multifamily transaction. The buyer was a publicly traded REIT. The deal was negotiated before COVID and closed after. This REIT thought at original underwriting that they were getting a discount to the price, so they thought they were getting a good deal. When COVID happened, what they did is they underwrote the deal, meaning they ran a DCF with a new set of assumptions. So what did they change? They increased their vacancy in the first year and in the second year. They increased collection loss in the first year, in the second year. So they're doing a 10-year DCF, and they've just adjusted years 1 and 2, and they reduced rent growth in years 1 and year 2. And then year 3 to 10, they assume that the typical projections, the typical assumptions that they would normally make. So they had 2 sets of underwriting. One was before COVID, which produced a certain level of return to their equity. And then the second post-COVID underwriting with the same price that they were going to offer, where they ran a post-COVID rate of return. So they looked at both returns, said, okay, in the first scenario, we were getting a very great rate of return. In the second scenario, we're paying the same price. We're getting a rate of return that we believe is reasonable given the risk that we are about to undertake. So they decided not to go back and renegotiate. Okay. So this is sort of one example, but the idea here is if you are in a market and you're analyzing a certain property type, find transactions that took place within a year or two, go back to those buyers and sellers and ask them what assumptions would they change if they were to underwrite a deal today. Would it be a vacancy? Would it be higher vacancy, lower rent growth, higher collection losses? But by doing that, it gives you an idea of how to underwrite in the new market. Another tool that we have is to interview participants, buyers or sellers that are active in the market. So people that want to buy, or people that are bidding on deals, and understand how they are viewing the market where you're in the property type that you're trying to analyze. And from that, you can learn a lot about what assumptions to make, how to build this 10-year discounted cash flow projection, what kind of recovery people are assuming. And obviously, you're going to have different viewpoints. Certain people are going to take a very cautious, very risk-averse view. Other people are going to be more optimistic. And if you follow this definition of market value, where we said the most probable price, so it is your job as an analyst, as a valuation professional, to sort of find this middle ground or find this most probable price and decide where you think the value would be, or where you think it's reasonable to conclude. But again, when you do go through this process, you'll see that the views are going to be very wide and very different. So it's going to be up to you to use your experience and judgment to come up with an estimate that you think is reasonable, and to come up with a forecast that is neither aggressive nor conservative, because when you do value, it's an exit concept. So you want to assume that a transaction will take place from both the buyer and the seller side, and not just skewed to one way. And then the last tool that we have is reviewing transaction activity. So usually when I say that in this event, people tell me, oh, there's no transactions, you can't draw conclusions. This is a typical response that I hear. And I'm not saying there are closed transactions out there, but there is activity. And I'll give you an example of something we went through recently, and people in New York, participants that are from New York will understand this. In mid-June of 2019, New York City passed new laws as to how rent-stabilized units will be regulated. So a lot of things that could be previously done in terms of taking rent-regulated units and converting them to market through renovations or tenant buyouts were no longer allowed. And this happened on June 15th, I believe, 2019. So a lot of our clients that are publicly traded, that are funds, needed to value their portfolios literally 15 days after this law passed, so as of June 30th. And to say that no transactions happened from June 15th to June 30th, therefore values haven't changed, was not really an accurate thing to do from a valuation standpoint, because it was clear that given the new rules, you were dealing in the new economic environment where buyers and sellers would no longer be paying the same prices for those types of assets. So I'll give you examples of what we did for our clients in order to gauge where new values were for rent regular units. And the same thing could be done in a pre-COVID and post-COVID environment. We've analyzed, we've reached out to the investing community, we've analyzed deals that were canceled. And in doing that, we weren't just looking at, okay, you had a deal for X and it was canceled. What we wanted to know, what we've learned was the following. Let's say there was a contract for an X amount, and after the new regulatory rules passed, the buyer went to the seller and said, okay, I'm going to pull out of the contract. At that point, we've learned that certain sellers gave the buyer 10 or 15 or 20% discount to the contract price. And if the buyer still backed out, that's transaction activity information that is very useful to your analysis, correct? You now know that even with a 10, 15, 20% discount, the buyers are still not going through with the deal. So that gives you an idea, okay, values are down by more than 10 to 20. I'm just using hypothetical numbers here, 10 to 20%. And there were cases where there were discounts that were given and the buyers closed the deal. So that again, like I said before, you're going to have two views, some very optimistic and pessimistic. So some buyers were canceled with a 20% discount, some buyers would close. Then we've analyzed the new listings that came on after the law. And we saw, okay, new list prices were down 10, 15, 20%. Again, gives you an idea as to the direction or starting to quantify the impact on property values. Then we looked at, what contracts were retraded. Okay, so if a buyer and seller agreed to a new price, maybe new contracts were signed for listings that took place after the laws were passed. So this type of transaction activity could be analyzed, even though there's no closed deals, there's still activity going on in the background that could help us as analysts to put together, a 10-year discounted cash flow that is reasonable and supportable. If anybody wants to ask me questions in the chat about this, I'll be happy to answer them. The chat is open. Otherwise, I will move on to the last topic that I wanted to address. The next slide, please. And that is financial reporting. So many of the players in the real estate, so a large portion of commercial real estate assets are owned by either funds or REITs, or entities that need to issue financial statements either to the public, if they're publicly traded, or to their investors who are institutional owners. I would say probably more than I don't like to say a number, but a large number of which. This is why I want to address the financial reporting aspect of this, because they will be dealing with some of the issues, some of the challenges that we're talking about. So certain type of entities need to report quarterly or annually based on fair value. So every year or every quarter, these entities need to tell their investors, here's what the value of our commercial real estate is. And these could be entities that need to comply with US GAAP based on the US reporting requirements, or IFRS, which are internationally financial reporting requirements. But either way, the process is the same. So these entities, whether these are private equity firms or funds or anybody else who decide, or international entities that have to comply with international reporting standards, they have to, in essence, value their real estate on a periodic basis and tell their investors what the value of the real estate is. So they're going to have to go through the process that we talked about and use some of the tools. And at Level Valuation, we help some of those companies value their assets, quarterly or annually for their financial. So they will need to go through the process of estimating values for their portfolio. Some of them as soon as March 30. So they'll need to decide, okay, how do we quantify what we're going through and make some assumptions that are not, again, like what Tino said before, so they don't want to have too much volatility, but you need to do something different. You can't just say values haven't changed, because clearly we're at a big economic standstill here, and most property values will most likely be impacted. And then you have entities that are report based on costs. So REITs, for example, real estate investment trusts, typically when they buy an asset, they list that asset in their financial statements based on the price that they paid, and they depreciate it every year, but they don't need to change the valuation unless there's a permanent, what is called a permanent reduction in the value of that asset, and this is known as a process of impairment. So if a company believes that COVID-19 has resulted in a permanent reduction to their value, and this company is the one that records the cost, they need to write it down. They need to take an impairment. So what kind of companies are these going to be? So hotel owners it'll probably take a long time for hotel values to recover. So if you bought a hotel in the last couple of years, most likely it is worth less today than it was worth before COVID-19. How much less? It's hard to tell. Retail, right? When you have most of your tenants not paying your rent, and most of the tenants filing for bankruptcy, whatever you have as a cost basis in your financial statement will probably need to be revisited, and most likely will be impaired. So in the financial reporting environment, there's going to be a lot of activity in terms of what are new values, and then which assets need to be impaired, and what are the new values will be for those assets. Tino, there's some questions come in. I'll just answer them, and then I'll give it back to you.
Sure.
So what discount rates do you use for DCF in this environment? So the important discount rates to buyers are equity rates of return. So you sort of have three buckets there. You have your core, which are 8 to 12%. You have your value added equity returns, which are 12 to 16%. And then you have your opportunistic returns, which are 20 or 16 and plus percent. So I would say in this environment, I don't see a lot of assets being placed in the core bucket. Even if you think, multifamily, the May collections were good. April collections, I think, were for the most part there. But I can see with 30 million people out of work, even multifamily assets not getting collections. So I could see equity returns being 10, 12 and up in this environment. I assume the buyer in the first example must not have reduced collections and increased vacancy by too much if the deal remained reasonable. A bit like the broker were there. Do you feel like there's a way to estimate at this point what will be occupancy level and rent levels after everything is said and done? Very difficult, and it's going to be based on the market where you are located and the property type that you're analyzing. So for example, if you are analyzing street retail right now in Manhattan, you're going to have, and street retail in the city has been in a bear market for the last 3 to 4 years, I would say. So now you're going to have more mom and pop going out of business. You're going to have more vacancy. So this is going to even add to the pain. So I'd say it's going to be asset by asset and location by location. But yeah, very hard right now to estimate what the vacancy will be, what the rent declines will be. Gino, I'll hand it back to you, and then I'll monitor the questions as they are coming in, and then we'll answer them at the end.
Great. Thanks a lot, Lev. So, I think one of the things that is clear as mud right now is an assumption that you could point to and say with a very, very high degree of confidence, that assumption is a reasonable assumption. But I think what Lev was able to highlight is there are ways of going out to the market to try to understand how market participants might look at and make assumptions around things like risk return, vacancy levels, rent levels. In the face of this challenge for valuing real estate, there are some regulatory and structural requirements for valuations that I think could potentially exacerbate the pressure on trying to pin down values in the current environment. So quickly, I want to highlight a few things. So CECL, current expected credit loss. This is an accounting standards board requirement that is going to be coming into play. It had anticipated to start beginning this year. However, it has been pushed out a little bit in terms of the requirement to reserve this capital in the event of losses. So what's the, who does it apply to? It applies to SEC filers in the fiscal years and interim periods after December 2019, and it takes effect for other non-public filers after December 2022. Why do we have CECL? It's an estimate of expected credit loss that you start booking based on your opinion of value the day that you take that asset onto your books. And the reason it's in place is in the prior market correction, you started to take reserves based on an incurred loss model, which means when you actually had the losses. So the idea of CECL is we're going to start to track and mark and reserve for potential losses, which obviously are very connected to the value of the collateral, the cash flows, vacancies, rent levels, as you go forward, so that in the event that you do have a loss that happens in the future, you're not going from 100% par value down to 50% without taking interim adjustments over time as you see a deterioration. So that's the, I think the concept behind why it's going to be something that all entities that hold loans, debt securities, and off-balance sheet credit exposures are going to have to use CECL to start to mark for adjustments. And that's where the valuation comes in. What is your value? Because that's going to help determine what your expected loss might be on that asset. You know, before, the way losses were recognized under current GAAP, when a loss is probable or incurred. The CECL proposal is no recognition threshold. So every reporting period is when you start to update these values. How big is this exposure? So, you know, we're talking about the challenges in creating a supportable, credible valuation and some of the ways we can look at it. But how big is the exposure? So, you know, based on TREP numbers that were derived from the Federal Reserve Bank, year-end 2019, there were $1.35 trillion of commercial real estate loans on the top 100 bank balance sheets. 1.35 trillion. Of that, 857 million were commercial properties, income-producing properties, almost 300 billion of multifamily, and 194 billion of construction and land loans. And as of year end, the non-performing loan percentage was 0.3%. Obviously, a very large market and very, very low non-performing numbers as of year end. Now, you don't have these numbers starting to come to the surface yet and be publicly available. In the CMBS market, because you are monitoring transactions on a regular basis, we are starting to see the initial numbers as a result of the COVID based on late payments that were experienced in April. And on the next page, I'm going to show you some of the most current information about what those late payments look like. Last comment I'll make is regarding REIT valuations. So REITs present a view on cap rates in the absence of transactions. The market is saying, here's what we think the share of the REIT is worth. There is an implied cap rate based on the valuation of the collateral that the REIT owns. And we'll look at some of those numbers. So as of the April data in the public conduit universe, so those are the multi-borrower transactions. If you look at the area circled in red, you'll see that as of the end of April, there were $42.7 billion worth of loans that were non-current. And of that $42.7 billion, the box above it, which says grace and less than 1 month, was the increase in the non-current loans just in April. So almost 32 billion of the 42 billion was as a result of April late payments. On the right side, you see public SASB universe. That is single asset or single borrower transactions. So those are large loans securitized by either pools of properties or large single assets. And as with the conduits, the total delinquent loans before of 0.5%, and as a result of the April debt service collections, are now 7.7% non-current, another over $10 billion that have gone non-current. So these are starting to show us that the losses are starting to potentially show their faces, the delays in payment. And I talk about this because when we look at these loans as they start to not make their payments, the CMBS structures require valuations be done during certain parts of the process. So I've highlighted a couple of definitions out of the PSA, or the pooling and servicing agreement, which is the document that dictates how the securitization parties act as they manage the transaction. So first one, the servicing transfer event. When does a loan get transferred from the master servicer to the special servicer? Special servicer being the party that is responsible for really monitoring and enforcing the documents. So the transfer will occur when any periodic payment is more than 60 days delinquent, unless there's a case where there's mezzanine debt, some other nuances, but for the most part, 60 days after the loan is delinquent, it would get transferred over to special servicing. So that chart that showed the April numbers, now that we're in May, those loans are going to be 30 days delinquent. Depending on what happens in May, whatever is in place as of the end of May, when they hit the 60-day mark, those will get transferred over to the special servicer. And the master servicer also has the ability to make a judgment when a payment is not likely to occur. So here's where the valuation requirements come in. You have an appraisal reduction event, which means that within 120 days after an uncured delinquency, an appraisal reduction event will occur, and that's going to require an appraisal to determine what the potential loss might be on that particular loan. So you think they're 30 days late now, at the end of this month, they're then 60 days. That gets transferred over to the special servicer. During the next 60-day period, those appraisals have to be done per the documents in order to determine if there is actually a reduction in collateral value. And then under the term appraisal reduction amount, the calculation which is very clear in the documents, will set forth a reduction in the bond proceeds, a loss, even though there wasn't an actual monetary loss yet, but a loss based on the appraisal. So we have this uncertain time with challenging data in order to come up with an appraised value. We have the requirement from FASB that says you need to value these properties on a regular basis and come up with an opinion. The CMBS documents say after a certain period of delinquency, you have to transfer it to special servicing, and then within a certain period of time, get the values, and the updated values will be used to estimate losses in these bonds. As far as the REIT market is concerned, again, I talked earlier about the implied implications from the REIT market. This chart from NAREIT shows by asset category what are the returns year to date for the different REIT sectors. And the black columns starting March 27th are positive numbers, the red negative. So you could see between the week of March 27th through the week of April 3rd, we went from positive to negative. Then back to positive the week of April 10th, then back to negative April 17th, 24th, and then the week of May 1st, we started to see some assets positive and some assets negative. The last column, year to date, is showing what the year to date returns are if you invested in a particular sector of the REIT market, whether it be office, industrial, et cetera. This is important because it's showing you this volatility. But in terms of coming up with implied cap rates, you could see that there are, that solid blue line is the implied cap rate for all of the REIT sector. And you could see the volatility, and then at the end of 2019, going into the first quarter, you could see it increase again. So it is now at the 15-year average implied based on historical cap rates across the REIT sector. When you look at individual components, you look at the apartment REIT sector and you see an increase. It had been very low. That dotted line represents the 15-year average. And then the 10-year average in orange, 5-year average in yellow. But during this last quarter, we've seen the cap rates increase approximately 125 basis points on average for apartments. And they're now at the 15-year average. For industrial REITs, we've seen that it had continued to drop, but now it's kind of leveled off if you look at the end of that 2020 period. Now, when you look at office and mall, you could see significant increases based on the implied cap rates from where the REITs are trading. You have north of the historical average in office, and then a significant spike in the mall REITs. I haven't touched on hospitality, but the hospitality implied cap rates chart looks much more similar to the mall REITs in terms of a spike. And this is a way of looking at what some indicator of what the market is saying they perceive value to be. So I want to stop here, and we have some questions that have come in. But what I'd like to say is what we've tried to talk about today is, you know, we have these different definitions of value. We have how they are traditionally determined based on the appraisal process using normal environment. And now we overlay this never having occurred before set of circumstances where the opinions of value are still going to need to be derived and estimated in the market, but in the absence of not only transactions, but any level of comfort as to when we might come out of this, which asset types might be more affected than others, and then what is the new normal going to look like as we do come out of this unusual time with the impact of COVID and the pandemic. So maybe what we'll do is, Lev, maybe you and I can take some of the questions, and then if anyone else has any questions, please please forward them on. And if we don't get to everyone's question, we will make sure that we can respond to you. So make sure that we have that you've registered, so that we have all of your information. And someone asked about the PowerPoint being available. We will make it available to everyone who's registered and provided all the information to us for the seminar. So I know, Lev, you grabbed before some of the discussion around discount rates, and what I want to talk about is, you talked about, someone asked about the direct cap method. Why is that considered ineffective? If you think about what direct cap is, you're taking an estimate of some normalized net operating income and then applying a yield expectation, a cap rate, which is a blend of debt cost and equity, debt yield and equity yield, to come up with an estimate that you would capitalize that net income to come up with an opinion of value. So first, your net income number is very difficult to peg right now. The cost and amount of leverage that's available in the market today for debt, and then how much more of a premium might an equity investor want to receive in order to take that risk on. So I think that's probably one of the challenges about direct cap. And how is discounted cash flow any better? Well, I think at least with discounted cash flow, it gives you the flexibility to look out, as Lev said with some of his transactions, beyond a couple of years, projecting hopefully some level of normalcy and stability. So maybe you have 2 years or 3 years or 1 year of more uncertainty, followed by hopefully some level of normalcy, so that cash flow that you would estimate and discount to today is a little bit more nimble in trying to come up with a valuation. I don't know, Lev, if you have anything to add.
Tino, I have 3 people raising their hands. I'm assuming they want to ask the question.
Okay.
So should we allow them to talk?
Yeah, let's, okay, so let's see. So is it Abhyav? Juvkar, I'm gonna, so you got a question?
Hello.
Yes.
Yes, sir. Actually, the real estate will be facing a cash flow problem at least for a year. So, do you think by lowering prices of around 10 or 20%, we could increase the demand from end users? What is your views on this?
I mean, I'll take a start, a cut at that first. I mean, I think the thing to, in terms of trying to estimate what the percentage adjustment might be that creates an effective, an adequate adjustment where the market would say at that price I'm willing to pay. It's still early to understand that, because there is so much uncertainty, not just in when things will normalize, but when you layer on the question of, will there be changes in office space? How will retail and restaurants address things like social distancing? And will that be something that is a short-term issue, a medium-term issue, or a long-term issue that has to be dealt with? So all of these things, I think, are going to be part of that ultimate decision-making. And it's also going to vary by sponsorship, the markets that the properties are located in, the quality and condition of the properties. So there's a lot of things that go into that. And I think that's why pegging a number would be very challenging right now. Alec, you had a question, Alec? I'm trying to, here we go.
Yeah, in the Q&A, I guess that, okay. So Lev had mentioned that the direct cap method wasn't going to work because of uncertain leasing conditions. So how do you derive an NOI and so forth? How could the DCF work then? Because you still don't have those cash flows to base your valuation off of without, you know, certain leasing assumptions because of what's going on with everything.
You know, and I addressed a little bit of that before. I think the difference between the direct cap and the discounted cash flow is the nimbleness of your ability to apply assumptions. Just because you have a 10-year period where you can tweak the assumptions doesn't necessarily mean that you can, that those assumptions are going to be easy to measure in the marketplace. But at least as you look going forward and as we have a better sense of timing and the impact, it'll at least be a little bit easier for you to adjust, even on a year-by-year basis, what your assumptions might be. And based on some probabilistic assumptions, how are you going to come up with that cash flow estimate that you would discount it today? Or is one completely supportable at this point and the other not? I think they're both challenging, but at least in a DCF, you have the ability to be more flexible in the assumptions and your timing to look out into the future. Direct cap, it's one number, it's right now, and that's a hard number to pick in the current environment.
Tino, there's a question. If I believe that COVID-19 will only have a short-term impact, can I make no change to my cash flow? You want me to take that one?
Yeah, give it.
So only if you have, the only scenario I can envision where this would make sense is if, let's say, you're valuing a triple net lease to McDonald's. So if you're valuing a McDonald's that's leased to, backed by a McDonald's corporation, and it's, you know, guaranteed by them, then the COVID-19 is probably not going to impact your cash flow. So at that point, you don't need to change anything. But I think in most scenarios, if you think, you know, hotels, multifamily, retail for sure, I mean, industrial to some extent will be impacted. So you will need to make some sort of adjustments. I mean, if not, then you'll just you might risk of overpaying for the asset.
And what I would add to that is it also depends on what your you know, what the purpose is. If you're going to hold it and there's no financial reporting requirements for you to have to adjust it, you can keep whatever assumptions you want. But if your expectation is because you're anticipating a bounce back in the market, then you don't need to make any adjustments. And your expectation is that a lender or a buyer would look at it the same way. I don't think that's very likely because the market is looking at this and saying, this is a stress in the environment that needs to be accounted for. It is now the bottom of the hour. It is 1:30. I actually, as much as I want to keep answering questions, I actually have a class that I have to teach now. So I'm going to move on to that class. But make sure that if you have questions, you, and if you'd like to email them, you can email them to NYU and we will try to get some responses back to you. Lev, thank you for participating today. And I want to thank everyone for joining us today. Hopefully this was valuable and we will again send out the PowerPoint. So again, thank you all. Be well and safe and more of these events to come. Thanks again.